When you look across the markets right now, something doesn't quite sit right. It's not just crypto pulling back, it's not just stocks wobbling, it's not just a bad headline or a bad day. You've got equities under pressure, crypto selling off hard, and then you look at gold and silver. The assets people usually expect to hold up when something gets uncomfortable, and even they're falling. And that's usually the moment people stop and think, hang on, this isn't how this is supposed to work. Because the simple story we're taught is that when risk assets fall, money rotates into safety. Stocks down, gold up. Volatility rises, defence assets step in. But right now, there isn't a clean rotation happening at all. Everything is being sold off at the same time. And when that happens, it's rarely because investors have suddenly lost faith in every single asset class at once. It's usually because something deeper is going on underneath the surface. What you're really watching is a system under stress. Now, I've seen people calling this everything from a black swan to a Six Sigma event. So let's ground this properly before we go any further. A true Six Sigma event is extremely rare. We're talking about moments like the 2008 financial crisis or the March 2020 shutdown, where liquidity disappears, correlations snap to one, and policymakers are forced to step in quickly to stop the system breaking. What we're seeing right now isn't quite that, but it does share some of the early fingerprints you tend to see when markets are dealing with a liquidity squeeze rather than a normal pullback. And that distinction matters, because this isn't about price, it's about pressure. Gold is actually the biggest clue in the entire story. Gold isn't a growth asset. It's not meant to behave like stocks or crypto. Its role is to sit quietly in the background and act as a hedge when confidence breaks down. So when gold starts selling off alongside everything else, that's not gold failing. That's a sign that people are raising cash. In stressed markets, investors don't sell what they want to sell. They sell what they can sell. They sell liquid assets to meet margin calls, reduce leverage, and regain flexibility. We've seen this before. In 2020, the same thing happened. Forced selling first, repricing later. So gold falling right now isn't a contradiction. It's a warning light. It's telling you liquidity is tight and leverage is being unwound. So when you zoom out to stocks, you see a similar story. This isn't about companies suddenly becoming bad businesses. It's not about earnings collapsing or innovation stopping. It's about financial conditions tightening, higher rates for longer, less liquidity sloshing around the system, capital becoming more expensive. When that happens, valuations compress, sometimes slowly, sometimes very quickly. Crypto fits perfectly into this picture. Crypto isn't leading the crash. Crypto is reacting faster because it's more liquid, more leveraged, and trades around the clock. When liquidity tightens, crypto feels it almost immediately. Historically, crypto often bottoms before equities because it clears leverage faster. And this is where things get interesting. Because when you stop focusing only on price and start looking at behaviour, you realise not everyone is reacting in the same way. Let's talk about whales. One of the clearest signals comes from the most obvious whale in the room, strategy, the company formerly known as MicroStrategy. While prices have been falling and sentiment has turned sharply negative, strategy hasn't stepped away from the market. They've continued buying Bitcoin aggressively, adding tens of thousands of coins to their balance sheet during this drawdown. These aren't rumours or assumptions. These purchases are publicly disclosed. And when you see a company of that size committing billions during a period of market stress, it tells you something important. They're not focused on the next candle. They're not trying to time the exact bottom. They're positioning for what they believe comes after this phase. Whether you agree with that approach or not, it matters. Because strategy isn't trading emotionally. They're making long duration decisions based on liquidity cycles, macro conditions, and their conviction in Bitcoin as a long-term monetary asset. But strategy isn't the only whale we need to talk about. Some of the biggest whales in this market aren't individuals at all, they're institutions. And the easiest way to see what institutional money is doing is through ETFs. And this is where BlackRock comes into the conversation. BlackRock's Bitcoin ETF has effectively become a real-time sentiment gauge for institutional positioning. When money flows in or out of that product, it gives you a pretty clean read on how large pools of capital are managing risk. And during this drawdown, there have been days where meaningful amounts of capital flowed out of that product. Not just noise, proper noticeable outflows. That doesn't mean BlackRock suddenly thinks Bitcoin is dead. It doesn't mean institutions have abandoned crypto. What it means is that in moments of uncertainty, large institutions tend to do what they've always done. They reduce exposure first and ask questions later. Big money prioritises flexibility. They de-risk early, preserve capital, and keep options open, especially when volatility rises and liquidity tightens. What's interesting though is that this wasn't happening evenly across the board. While some ETF products saw outflows, others were seeing smaller inflows at the same time. That tells you that this wasn't a blanket rejection of the asset. It was rotation, rebalancing, risk management. From the outside, it looks like institutions are selling. From the inside, it looks more like institutions are adjusting. Different mandates, different time horizons, different risk tolerances. And when you place that next to what strategy is doing, continuing to accumulate, the picture becomes clearer. This isn't one group all doing the same thing. It's multiple layers of capital responding differently to the same stress. Short-term institutional money is de-risking. Long-term conviction capital is positioning. Retail is emotionally caught in the middle. Now, we need to zoom out to macro because none of this is happening in isolation. A big part of what markets are reacting to right now is a shift in expectations around monetary policy, particularly around the Federal Reserve. Markets are extremely sensitive to liquidity. When investors believe liquidity will be plentiful, risk assets thrive. When they believe liquidity will tighten, everything reprices. A stronger dollar, higher yields, tighter financial conditions. All of these things put pressure on assets that were priced for easy money. And when that shift happens quickly, you don't get an orderly rotation. You get a scramble for cash. There's also another layer worth talking about, because a lot of people have asked whether geopolitics, specifically Iran, could be part of what markets are reacting to. And the honest answer is yes, it's possible, but probably not in the way people imagine. Markets don't need a war to start repricing geopolitical risk. They just need uncertainty to rise at the wrong moment. Tensions involving Iran matter primarily because of energy. Iran sits close to some of the most critical oil infrastructure in the world, including the Strait of Hormuz, which handles a huge portion of global oil shipments. When tensions rise in that region, even without a single barrel being disrupted, traders start pricing risk. That shows up first in oil, then in inflation expectations, then in yields, and eventually across risk assets. And timing is everything. In a market with plenty of liquidity, geopolitical noise often gets shrugged off. But in a market where financial conditions are already tight, leverage is high, and confidence is fragile, that same geopolitical uncertainty doesn't get ignored. It gets layered on top. Oil volatility feeds into inflation fears feed into rate expectations, and suddenly assets that were priced for stability have to reprice for uncertainty. That doesn't mean markets are predicting an imminent conflict. It means they're adjusting for risk at a time where there isn't much margin for error. So this isn't about Iran being the cause of the sell-off. It's about Iran being one more stressor in a system that was already under pressure. Now, this is the part I want to slow down for, because this is where a lot of people feel overwhelmed. Trading crypto as a retail investor is hard. There can often feel like there are barriers to this wealth people talk about. It feels lonely, it feels confusing, it feels like everyone else knows something you don't. That's exactly why we set up the Crypto Wolf Pack. We break down these topics properly, without panic, without noise, and without pretending this stuff is simple. We also go deeper on this on the UK Crypto podcast as well, because understanding markets like this isn't about predicting tomorrow's price. It's about understanding structure, liquidity, and psychology. So join me and Milkshake Matty on the UK Crypto podcast. We drop weekly episodes right here on YouTube, and you can also listen on Spotify. And if you are trading this market and you want to know the exact strategies we use in the Crypto Wolfpack to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description. So where does this leave us? This isn't a true Six Sigma event, but it is a system under stress. It's the kind of environment where leverage gets cleared, weak hands exit, and patient capital starts positioning quietly. These phases don't last forever. They resolve either through stabilisation as selling exhausts itself, or through a policy response if something breaks badly enough. The key isn't watching every tick. The key is watching behaviour, watching flows, watching whether correlations stay locked together or begin to loosen. In true crisis moments, everything moves as one. In stabilisation phases, differentiation returns. And that's how you know pressure is easing. So if I leave you with one final thought, it's this. In the middle of market stress, your brain tells you everything is ending. Most of the time, what's actually happening is a transfer from emotional hands to patient hands, from leverage to conviction. The question isn't whether this feels scary. The question is what the strongest players are doing while everyone else is panicking. If this helped you to see the bigger picture, make sure you like the video, subscribe to the channel, and let me know in the comments. Do you think this is just another leverage flush? Or are we watching something much bigger unfold? Thank you so much for watching, and I'll see you in the next one.